Welcome, America, to an episode of Multi-Generational Tax Planning, how to never pay taxes on your income and on the growth of your family's investment. Sound too good to be true? In many cases it might be, but sometimes there is a legal loophole which can allow you and your family to build generational tax-free income. Does that sound amazing? Sounds good to me. Well, I'm a CPA and a licensed financial advisor coming out of the state of California and consult with people nationwide depending on licensing and registration. If you want to know if I'm available to consult with you in your state, it shouldn't be a problem, but I may have to go through some additional registration to talk with you wherever you're at. But for most states, all 50 states, I'm licensed for tax work. So just giving you a heads up, my contact information you can find here. We've got a new QR code, so feel free to use the QR code if you want to scan that to get a hold of me. Multi-generational tax-free wealth building. How does that work? This video is for the people who are willing to trust and work with their financial advisor and CPA to come up with strategies to make the most out of their family building wealth. If you're a family business owner, you can actually take advantage of a deduction that allows you to pay your kids. The catch is your kids got to do something worth of value to the family, but it helps you avoid a lot of taxes. You can avoid some federal income tax, you can avoid some self-employment income tax, and you can avoid some state income tax, as well as the Social Security income taxes and things like that, which I think that's already the self-employment taxes we talked about. How much taxes? Well, if you're in a normal tax bracket, say making $100,000 or more, that can be almost 50% of your income going between federal and state taxes. Well, wouldn't it be nice if you can keep 100% of your income and put it towards your family? Well, to a degree, we can start shifting that income to stay in your pocket rather than giving it to Uncle Sam. Well, how are we going to do that? Let's take a look. First, I want to briefly review something of what's happening with taxes in general. So let's go ahead and get into it here. Here are the tax brackets that we have every year. And you might notice in the beginning, you're going to pay on the first $11,000 you make. This is if you're single. If you're married filing jointly, this is care of our friends over at Nerd Wallet. I like to go to that website to look up the tax brackets. If you're married, the first $23,850 is going to be subject to 10% tax. Well, it doesn't take too long before a married couple ends up in the 24% tax bracket. And if you're in California, you might end up having 8% more tax and then also 15% self-employment tax on top of that. 28 plus 8 plus 15. Pretty soon you're at 47% tax. You're almost hitting that 50% tax. Now you start hitting that a lot faster when you're single. When you're single, once you hit around $100,000, you start hitting that. Now, supposing you have kids, you're probably going to be doing married filing jointly, or perhaps head of household. Head of household, you hit that 24% tax bracket right around the $100,000 mark also. Now, what taxable income are we able to get tax-free? Well, there is a thing called the standard deduction. The standard deduction is the amount that the government allows you to earn without paying any taxes on it. They give you a certain amount that they're saying we're not going to have any federal income tax on this amount. Now for 2025, if you're single or married filing separately, you can earn up to $15,000 and it's not going to be subject typically to any state tax, income tax, or any federal income tax. Now, if you're married, qualifying spouse, surviving spouse, etc., $30,000. Head of household, you get a $22,500 deduction. Well, how does this work? Well, one thing that we can do is we can think about, if you're a business owner, you could take some of your income that you've earned and you could expense it to pay your kids. Now, not only do you get a deduction for your earned income, a standard deduction, your children also get a standard deduction. What if you paid your kid about $15,000? That child could receive that money, and because it's at or below their standard deduction, they wouldn't be required to pay taxes on it. But yet, you get to deduct that as a business expense, and that lowers your taxable income, that income that you would already been paying 47% tax on. Now you get to pay your child, who you're probably going to support and stuff anyway, and they get to keep the whole amount. They don't pay any federal tax, they don't pay any state tax. And by the way, when it comes to that nasty self-employment tax that people feel like they're always getting hit with that they didn't plan for, if they're working for your family business, we're going to take a look at family employees. Now, if they're 21 or under and they're your children, they may not be subject to tax withholding. You're not subject to Social Security and Medicare taxes until the child reaches age 21. Let's get this straight. We got rid of the federal tax, perhaps up to a certain amount. We got rid of the state tax, perhaps up to a certain amount. And we got rid of the employment taxes up to a certain amount. So rather than keeping $7,500 in your pocket after taxes, you may be able to pay your child $15,000. But as a family unit, if you view yourself as a family, instead of only having $7,500 in the family, now you have $15,000 in your pocket at the end of the year. Can it get any better? Well, perhaps it can. What about if, since your child has earned income, you work with your financial advisor? Now, in my case, I'm a financial advisor and a CPA, so that's one of the advantages I can put together for you if you decide to work with me. If you want to work with me on this strategy, feel free to contact me. What they can actually do is you can qualify to set up IRA for your children. So get this, you don't get a deduction for that the year when you set it up, but later on you actually will be able to deduct. You'll actually be able to have the earnings and you'll get the money back. You'll get it back tax-free. So hypothetically, you paid taxes before you put it in. You don't have to pay tax on it again when you take it out with a Roth. Now, when you're earning below the standard deduction, that means you never paid taxes on it. However, you can still qualify because you have earned income to set up a Roth for your children, which that means your children can set up an investment account and they can invest and grow their money. You never paid income taxes on it as a family because you took a deduction for your kids and for your business. Your kids get to put it into a Roth, and since they didn't pay taxes on it before, but it's in a Roth, they're going to be able to take it out tax-free in the future when they need it, and all the growth for their entire life in the Roth is going to be tax-free. So that's my tip for the day for you, my viewers, Max Drew CPA. If you want to do this strategy, there is some complexity to it. I believe you're going to definitely want to work with your CPA and financial planner to get the right consultation. Make sure you understand the fine points and realize that there are some legal obligations that you have to meet in order that this is going to be truly tax-free on all levels. But is that as good as it gets? Well, perhaps not. Believe it or not, you can also, because your child has earned income, you could also set up what's called a Roth IRA. Now remember, even though your child has earned income, if you paid them below the standard deduction, they may not have any tax obligation related to that income they earned. However, they can still qualify for a Roth IRA. So if you want to enact this strategy, I don't recommend you do it on your own without incorporating the help of a qualified CPA and a financial advisor. Luckily, I happen to be both. Now just imagine that you got a deduction on your taxes for paying your children and got you out of that 47% tax rate. Your children get to put that money in their pocket, in your family's pocket, if you view yourself as a family unit. And then on top of that, your children get to start investing in a Roth IRA, which will allow them to have tax-free growth on their investment for the rest of their life. So it's going to be an amazing strategy where you and your family can build tax-free, multi-generational wealth for your family. I hope you enjoyed this tip, and if you would like to get some help exploring how to practically enact this and do this on your own taxes if you've got a family business, I would be happy to consult with you on the free points. Feel free to get in touch with me. Thanks for joining me today. I hope you have a wonderful rest of your day. today. Looking forward to serving you and your family if you decide that you would like my help. Take care. Max Drew, your friendly neighborhood CPA out of Sacramento, California, and serving the United States of America as your CPA. Take care. Love you guys. Bye-bye.